welcome to this section on lease accounting. And to make this fun and exciting, let's talk about leases like a story of the lessor and the lessee. And this story is about how they come together. So guys, a lease is a contract between the lessor and the lessee, where the lessor or the landlord, now he owns certain PP&E, certain property, plant and equipment, which is there on the lessor's balance sheet. Now the lessor or the landlord gives the right to control the use of this PP&E to the lessee, who's the tenant. So once again, we're talking about lessor's PP&E, which the lessor gives to the lessee for a certain period of time in exchange for consideration or rent. So guys, when we look at the lessee is paying out periodic rental payments to the lessor. So when we look at the lessee's income statement, the lessee is going to have a rent expense, or let's call it lease expense. The lessor, he's getting the money from the lessee. Let's call it lease income on the lessor's income statement. Guys, note that we are talking about the lessor's PP&E. The lessor owns it. The lessor is the owner. And the lessor would have to depreciate PP&E because PP&E depreciates over time. And the lessor will also have a depreciation expense on its income statement. So guys, this is just the beginning of the story. Let's get to the book now. Look at lease accounting for short-term leases. So when I say short-term, we're talking about 1 year or less. And then later, I'm going to talk about operating leases which have a lease term of over 1 year. And I'm also going to introduce all of you to finance leases. On page 26, we're looking at leases. Highlight: a lease is a contract or a part of a contract between the lessor, who's the supplier, and the lessee, who's the customer. Now, this contract, highlight, conveys the lessee the right to control the use of lessor's identified asset or identified PP&E, property, plant and equipment. This right is conveyed, highlight, for a period of time in exchange for consideration. So right there, lessor, he's the landlord, and we also refer to the lessor as, right, supplier. Lessee, that's the tenant, and we also refer to the lessee as, right, customer. On page 34, we are looking at, put a box around short-term operating lease, which are leases with, highlight, lease term of 12 months or less. Now, for these short-term operating lease, when we talk about accounting for, put a box around lessee, the lessee has an option to highlight recognize the lease payments on the income statement on a straight line basis over the lease term. And in this case, the journal entry for the lessee would be a lease expense debit and of course cash paid out credit. So where you have lease expense, right there, I/S income statement, because that lease expense, that's an expense item on the lessee's income statement. For, put a box around lessor, there's similar accounting underlying for all operating leases, whether it's a short term or not a short term lease, whereby highlight the lessor recognizes the receipt of lease payments on the lessor's income statement on a straight line basis over the lease term. So for the lessor, it's lease income, which is the credit on the journal entry. Right there, I/S or income statement. So that lease income is an income item on the lessor's income statement. So guys, this is simple and easy. For the lessee, the lease expense is an expense on the lessee's income statement. For the lessor, the lease income is an income on the lessor's income statement. Let's talk about Walmart, which has got thousands of retail stores all around the world. Now, Walmart can buy the real estate of its retail stores. Think about it. If Walmart buys the real estate, Walmart on its balance sheet would have an asset. But the challenge would be that Walmart would have to take a loan to finance the purchase of that asset. So Walmart would have an asset and a liability. Now, the challenge with liabilities is that investors generally don't love them. So instead of buying that retail store, Walmart can lease it out from a lessor, where Walmart becomes the lessee, and let's say the shopping mall guy becomes the lessor, and the shopping mall or the lessor is leasing out space to Walmart, the lessee, let's say for 5 years. Now, in this case, Walmart has a challenge that what if after 5 years the shopping mall, the lessor, does not renew the lease? Because Walmart, they generally don't want to move their retail stores. They establish themselves in the particular place where they start. So guys, let's talk about it again. If Walmart is buying properties, the challenge is loans, liabilities. If Walmart is leasing spaces from lessors, the challenge is it may not get to use that space forever or for a very long time. Now, how about Walmart acts smart and tries to get the best of both worlds? Think about it. Walmart can structure the leases in such a way that though the lessor is the legal owner on paper of the property, Walmart, the lessee, becomes the owner in substance. So what we're talking about is lease structures where though the lessor is the legal owner, though the lessor is the owner in form, the lessee becomes the owner in substance. And these leases, we'll call them finance leases from a lessee perspective. And let's talk about them. So guys, we are talking about finance leases. When we are saying these are leases which are structured in such a way that in substance the lessee is the owner of the asset. So the lessor still is the owner legally in form. In substance, the PP&E belongs to the lessee. And let's talk about these owner criteria. Guys, owner, that's a mnemonic for 1, 2, 3, 4, 5 criteria. Any one of the 5 being met, it becomes a finance lease. Let me put that down here. So we're talking about O, W, N, E, and R. Let's look at it. Let's talk about the first one. Ownership transfer or title transfer. So let's say the lessee, let's say Walmart, enters into a lease with a lessor in such a way that the lease is for a 5-year term, and at the end of 5 years, the ownership of the asset transfers to Walmart, the lessee. Look at this. So Walmart is going to have a leasing arrangement of 5 years. After 5 years, the property will be owned, legally owned by the Walmart, the lessee. So that's an example of a finance lease, where though it looks like a lease, it's actually Walmart or the lessee buying that property. But instead of paying the money upfront, paying it over 5 years. Over 5 years, it looks like a lease, but actually the lessee, Walmart, will own the asset ultimately. That's the O of owner. The first criteria, or one of the 5 criteria that we have for a lease to be a finance lease. Let's look at the next one, W. Now, W stands for a written option. Let's say a written bargain purchase option. Let's talk about a lease which is structured in such a way that it's a 5-year lease, and after 5 years, the lessee, let's say Walmart, has the option of buying the asset for half its fair value. So basically, we're talking about a leasing arrangement where after 5 years, the lessee, Walmart, can buy the asset at a throwaway price. Now, will Walmart buy or not buy? Of course they'll buy. It's half the value. So guys, that's an example of a bargain purchase option. Now, this written bargain purchase option makes the lease a finance lease, where in substance, lessee or Walmart is the owner. So that's a second criteria, W, or the second of 5 criteria. Again, as I said, any one of these 5 being met, the lease becomes a finance lease. Let's move on to the third one, the N of owner. And this N stands for no alternative use. So let's say Walmart is getting a technology company develop robots for its warehouse. Now, those robots which Walmart is leasing from that tech company are custom made for Walmart in such a way that nobody else would have any use for those robots. Now, even if those robots are leased on, let's say, a 5-year term, the lessor, that tech company, won't have any use for the robots because those robots have no alternative use. This lease is again a finance lease because once again, though the tech company, the lessor, is the owner of that robot in form, on paper, in substance, Walmart or the lessee is the owner. Let's talk about the next criteria. I know this is getting really exciting. The E of owner. Now, the E of owner stands for equal or excess present value. Let's talk about that. So, we are saying equal or excess present value. So, what we are saying is the lease is structured in a way where the present value of all the payments that the lessee is going to make to the lessor is equal to or excess or greater than 90% of the fair value. So let's put that here. So the present value is greater than or equal to 90%. So basically what we realize in this case, or let me write that, greater than or equal to 90% of fair value. So what we realize in this case is that the lessee is committing to pay a lot of dollars over the lease term. And because the lessee is paying so much, it seems as if lessee is taking over the property. It seems as if the lessee is the owner in substance. So once again, we're saying that the present value of all the payments that the lessee is going to make is equal to or more than 90% of the fair value of that PP&E which the lessee is leasing from the lessor. The last criteria, the R of owner, stands for remaining economic life. So let me put that here. This is the R of owner. We're talking about remaining economic life. So what we're saying here is the lessee is leasing the lessor's PP&E for most of its remaining economic life, for let's say 75% or more of the remaining economic life. Let's say the lessee does a 99-year lease for a building. That's like all the life for that building. That's going to be a finance lease, where once again, in substance, the lessee is the owner. So guys, let's get to the book. Look at this owner criteria once more time, and then we'll come back and I'll do a magic show to help you understand how we do the accounting and reporting for finance leases. On page 36, we're looking at finance lease, where the lease terms are as if the lessee is the owner of the asset. The lessee must meet any circle 1 criteria to treat the lease as a finance lease. And on the bubbles that follow, fill in O, W, N, E and R. So the lessee must meet any one of these owner criteria for the lease to be classified as a finance lease. Let's look at the O of owner. Highlight ownership transfer, whereby the lease transfers ownership of the underlying asset to the lessee, underlined by the end of the lease term. So this is like, right, a title transfer at the end of the lease. The W of owner is highlight written purchase option, where the lease grants the lessee an option to purchase the underlying asset, underline that the lessee is reasonably certain to exercise. For example, the lessee has an option to purchase the asset from the lessor at a price which is estimated to be 50% of the asset's then fair value. So guys, this one is an example of, right, a bargain purchase option. And this one's the W of owner. The N of a mnemonic owner is highlight no alternative use, where the underlying asset is of a specialized nature such that it is expected to have no alternative use to the lessor at the end of the lease term. In other words, the underlying asset has been custom made for the lessee's use and no one else will have any use for it. The E of owner is highlight equal or excess present value, where the underlying present value of the sum of the lease payments, circle, and underline any residual value guaranteed by the lessee. And this number, underline, equals or exceeds substantially all of the fair value of the underlying asset. A reasonable approach to assess this criteria is whether this present value is highlight 90% or more than the fair value. In other words, we know that the lessee is heavily investing in the asset by committing to pay a lot of money, and the present value of all that the lessee is committing to pay is 90% or more of the current fair value of the underlying asset. The R of owner is highlight remaining economic life, where underline the lease term is for a major part of the remaining economic life of the underlying asset. And a reasonable approach to assess this criteria is to look at whether the lease term covers highlight 75% or more of the remaining economic life of the underlying asset. In other words, we know that the lessee will use the underlying asset for most of its life. Again, guys, all these criteria lead us to believe that the lessee is the owner of the asset. Hence a mnemonic owner, OWNER. We've been doing a lot of serious studies. It's now time for some entertainment. It's time for some magic by your very own CPA magician, Varun Jain. Guys, every magic trick consists of three parts or acts. The first act is called the pledge, where the magician shows you something ordinary, like a deck of cards, a bird, or a girl. As a CPA magician, I show you this PP&E on the lessor's balance sheet. Then we have the second act called the turn, where the magician takes the ordinary something and makes it do something extraordinary. But you won't clap yet, because making something disappear just isn't enough. That is why every magic trick has a third act, the hardest act, the act we magicians call prestige. This is the part with the twists and turns where you see something you've never seen before. Back again on page 36, we're looking at finance lease. And towards the bottom of this page, let's make little notes. Right there, substance over form. So in case of finance leases, right, even though the lessor legally owns the asset, that is in form, the asset moves from the lessor's to the lessee's books as if the lessee is now the owner. So guys, here the accounting standard setters have ensured that there is substance over form. Even though the lessor legally owns the asset, which means the lessor owns the asset in form, the asset still moves to the lessee's books, because in substance, the lessee is the owner. When we started, I told you lease accounting is a story. It's a story between the lessor and the lessee and how they come together. Now, let's look at the lessor side of the story once again. So, the lessor owns property, plant and equipment, which the lessor leases to the lessee in return for rental or lease income. Now, let's say when the lessor goes out and buys this property, plant and equipment, the lessor takes a loan from the bank. Let's say he's got a mortgage loan. So, let me put that up here. So, let's say the lessor has a mortgage. So, the lessor, of course, he's getting lease income because he's leased out this PP&E. But he's having to depreciate the PP&E because it gets depreciated over time. He's having to repay this mortgage loan. And as he's repaying the mortgage loan, he's having an interest expense on his income statement. Now, if the lessor and the lessee enter into a finance lease. Now, in case of a finance lease, we've discussed, though the lessor is still the owner in form, though the lessor is still the legal owner, in substance, the lessee becomes the owner. And when I showed you my magic trick, I'm sure you remember what happened. This PP&E, which was on the lessor's balance sheet, in case of a finance lease, this PP&E moved. It magically disappeared and it went to the lessee's balance sheet. So guys, let's do it once again. So we are talking about this PP&E, which is moving off the lessor's books because the lessor and the lessee have entered into a finance lease where it appears, or in substance, it's the lessee, the owner. So this PP&E moves to the lessee's books, where we'll call it right of use asset. So guys, once again, what's happening here is we are getting lessee to wear the owner's hat. Think about it. If the lessee had purchased the asset, if the lessee was actually the owner, the lessee would have an asset. The lessee might have had to take a loan. The lessee over the period would have to depreciate the asset and repay the loan, incurring interest expense. And that's exactly what we'll do even if the lessee is leasing property as part of a finance lease. So we saw the asset which moved in from the lessor's books to the lessee's books. On lessee's books, we will also have a lease liability. So I'm sure you understand what's happening. It's as if the lessee has gone out and purchased the asset. The agenda that the standard setters had here, that when the lessee entered into a finance lease, the standard setters did not want to allow the lessee off balance sheet financing. So technically, in a lease arrangement, you do not want the lessee to have an asset or a liability, and that's the earlier rules. So the standard setters said, no, that's not okay. Let's bring that on the balance sheet. And that is where this liability appears on the lessee's balance sheet even in a leasing arrangement. So we're talking about a finance lease here where the lessee has a right of use asset and a lease liability. On the lessee's income statement, we'll no longer see lease expense. So we see that in operating leases, and I'm going to come back to you about operating leases. But as far as a finance lease is concerned, the lessee's income statement no longer has a lease expense. Instead, the lessee's income statement would have the amortization of this lease liability as the lessee is making lease payments, which is resulting in interest expense. And the lessee is also going to depreciate / amortize this right of use asset, leading to amortization expenses. Think of it like depreciation. So guys, what's happening out here is, even though it's a lease arrangement, because it's a finance lease, the lessee is actually acting like an owner, wearing the owner's hat. The lessee is having an asset and a liability on its balance sheet. the lessee is not having a lease expense or a rent expense on income statement. It's instead having depreciation expense and interest expense, which the lessor had on its income statement. So guys, with this starting point, let's look at an elaborate example so that we connect everything we just discussed. We're going to look at the lessee's perspective. In a finance lease, we'll look at how the lessee would capitalize a right of use asset and record a corresponding lease liability. How the lessee would amortize this lease liability over the lease period, resulting in interest expense. How the lessee would amortize this right of use asset, resulting in amortization expense. And at the end of the lease, at the end of the asset life, depending on the case maybe, this becomes zero, this also becomes zero ultimately. And let's look at an example to sort of put all of this together. So we have this on 1st Jan year 1, lessee company leases from lessor company. So again, guys, it's always a story. The lessee and the lessor. Equipment for 5 years. So the lease term is 5 years with $25,000 payable at the end of each year. So guys, this one's an ordinary annuity where you have money payable at the end of each year by the lessee to the lessor for 5 years. The asset life, however, is 10 years. And the lessor's carrying value is $120,000. So on the lessor's books, that PP&E is for $120,000. At the end of the lease, the estimated residual value of the asset is $60,000. So the PP&E, which is $120,000 on the lessor's books now, at the end of the lease, it's estimated that the residual value will be $60,000. It says, however, the lessee has the option of purchasing the asset for $45,000 that the lessee is reasonably certain to exercise. So guys, think about this. We're talking about the lessee leasing the asset for 5 years. At the end of 5 years, the estimated residual value for the asset is $60,000. But the lessee has an option of buying it for just $45,000. Just think about it. You get something for 60 which you can shop for 45. Do you think you can spare it? Ladies, what do you say? Nobody would leave it. So something worth 60, you're getting it for 45. That's like a bargain purchase option. And in this case, it's clear, it's explicit that the lessee is reasonably certain to exercise it, to take the asset. In this case, the W criteria is met. And we discussed, if any one of these 5 criteria are met, the lease is a finance lease, where the lessee will wear the owner's hat. In substance, it's the lessee who's the owner. Let's look at the other facts that we have here. It says lessor incurs no initial direct costs in connection with the lease. We'll talk about initial direct costs later, but in this example, it's out. The rate implicit in the lease is 10%. So use 10% as your discount rate. So let's look at it. They also have given us the present value of ordinary annuity for 5 years. They've given the present value of $1 after 5 years. So we've got all the information that we needed. Now let's get started with our journal entries. The first one, we'll have to sort of get this asset and the liability on the lessee's books. So let's do the journal entries on the other side of my board. So we are looking at a finance lease. We are looking at the lessee perspective. So let me say lessee. And we start with creating the asset and the liability on the lessee's books. So on the lessee's book, we're going to record a right of use asset and a credit would be to lease liability. So guys, here we would have the present value of the future lease payments. Let's look at the lease payments. So the lessee is paying the lessor $25,000 for 5 years, and it's an ordinary annuity. So $25,000 into 3.79079. That's the present value of ordinary annuity for 5 years at 10%. And the lessee is also expected to pay $45,000 to the lessor at the end of the lease term. That's at the end of 5 years to buy the asset at a bargain purchase price. So that's $45,000 multiplied by 0.62092 to get the present value. So overall, the present value of lease payments calculates to $122,711, and that's going to be the number that we'll have for the lease asset, the right of use asset, and the lease liability. So guys, this one's our first journal entry, the first one. Now, the moment we have this, we have the lessee's balance sheet in order. So let's look at it on my dashboard. So on the lessee's balance sheet, we create the asset and the liability. Now, as I said, let's first look at amortizing this lease liability. And then step number 3, we'll amortize the lease asset. But let's do the liability first. So what we are saying is to amortize this lease liability of $122,711, we'll build out an amortization schedule. I'm sure by now you all are experts in amortization schedules. We've done that in bonds, we've done that in debt restructurings, and we're going to use a similar schedule for lease accounting. So let's do that. So let's look at this 5-year period. So let me have the headings in place. So we have period, and then you have interest. Interest is going to be at 10%. Then we have the lease payments. Then we have the plug for amortization. And then we have the lease liability carrying value. Perfect. So we're going to amortize the 122,711. So let me have this number out here. 122,711. And we're looking at a 5-year period. So year 1, 2, 3, 4, 5. So let's look at year 1, rather end of year 1. So 12/31/1. Now, at the end of year 1, the interest expense on this lease liability at 10%. So 122,711, 10% would be 12,271. So let me get that number here. 12,271. Lease payment at the end of each year is $25,000. So you're going to have a lease payment of $25,000. So look at the plug. So you have 12,271 minus the 25. So let me say minus 25 equals 12,729. So we say 122,711 minus 12,729. At the end of year 1, the lease liability carrying value is 109,982. So guys, I want you to understand what's happening here. Let's get back to the dashboard. Look at this. So what we're saying is we start off with a lease liability, the lessee's lease liability of 122,711. At the end of year 1, there's an interest expense for the lessee of 12,271. the lessee also makes a lease payment of $25,000 to the lessor, such that the lease liability balance at the end of year 1 reduces to $109,982. I'm sure you're getting the feel. Let's get back now. So that's year 1. Let's now do year 2. So 1231 x 2. Again, we're talking, so we took 10% interest here. Let's take another 10%. So just draw this arrow better. Yeah. So this comes on here, 10% interest. Let's take another 10% of this. So 10% of 109,982 would be 10,998. And the lessee makes lease payment again. That's a fixed amount, $25,000. So the plug 10,998 minus 25,000 would be 14,002. And then 109,982 minus 14,002 gives us 95,980. So amortization schedule. You're amortizing this lease liability. Guys, understand, at the end of 5 years, we want this number to become 0 at the end of the lease term. So we are reducing it every period. We are recognizing the interest expense, but we are reducing it by the lease payments. So net, it's a reduction. Let's get to year 3. So again, a 10% interest on this, 10% on 95,980 gives you 9598 of interest. So guys, we're talking about 1231 x 3, year 3 now. Lease payments is minus $25,000, a fixed dollar each period. The plug here is 15,402, which gets you to 80,578 carrying value. Now again, 10% of this, 1231 x 4, we have 805. 10% of this is 8058. Yep, that's correct. Minus $25,000. The plug is 16,942. That's correct. 63,636. And then let's do year 5. 1231 x 5. And then we again have 10% of this, which is going to be 6367. Or let's say, just to get the numbers right, we'll take 6364, just to account for the rounding of errors. And then you have minus $25,000. You get the plug, which is minus 18,636. Guys, 6364 minus $25,000. It's 18,636. 63,636 minus 18,636 is $45,000. If you remember, the lessee in this lease has a bargain purchase option of purchasing this asset at the end of 5 years for $45,000. And we said the lessee is reasonably certain to exercise that option to buy the asset for a mere $45,000. And that's why we have the $45,000 carrying value at the end of 5 years. Now, at the end of 5 years, if the lessee makes the payment of $45,000, buys off this lease asset, $45,000 minus 45, the lease carrying value would become 0. So guys, as you understand, we have amortized this lease liability over 5 years. In the process, of course, we've had interest expense, and we see all the lease payments, $25,000 over 5 years and $45,000 at the end of 5 years. A total of $125 plus 45, which is $170,000. Let's quickly get the journal entries in place for this. So let's look at this, right? So we're looking at interest expense, which is actually increasing the lease liability. So we're going to have an interest expense on the lessee's income statement, which will result in increasing, bloating up the lease liability. So let's have the journal entry for that. So we're looking at interest expense and lease liability credit. And this is going to be over 5 years. So we're going to have it for X1 or 1231 X1, and we're going to have it for X2, year 2. We're going to have it for year 3, year 4, and then year 5. Year 1, the interest expense is 12,271, and the lease liability credit would again be 12,271. Year 2, swapping my pants. Okay, year 2, the interest expense is 10,998, and the lease liability would bloat up by 10,998. Year 3, 959. Again, same numbers that we have on the amortization schedules coming in as interest expense at 10%. 9598, and then you have 8058, 8058, and then 6364, 6364. Perfect. Now, the second journal entry that we're going to be having is basically the lessee making the lease payments in cash to the lessor. As the lessee is making these lease payments, we're saying how these lease payments are helping us reduce the lease liability. So guys, every year the lease liability, we're doing a plus interest minus the lease payments to get to the plug. So let's do a journal entry on this. So we're saying lease liability to cash. So year 1, the lease liability paid off, the lease payment is $25,000. Year 2, same number, $25,000. Year 3, again, another 25. Year 4, again, the lessee pays $25,000. Year 5, once again, the lessee pays 25. But along with that, the lessee pays another $45,000 to actually buy the asset at a bargain purchase of price. So the lessee overall in year 5 pays off 25 plus 45, which is about $70,000. So let me sort of combine these two payments and write $70,000 for year 5. So guys, as you can understand what's happening here. So this is our second set of journal entries. Now here the interest expense, that's going to the income statement of the lessee. And we discussed about that, right? So let's quickly look at the dashboard once again. So the lessee has a right of use asset and a lease liability. We have amortized this lease liability over the 5-year period, resulting in the creation of interest expense on the lessee's income statement. So unlike a typical operating lease where the lessee would have a lease expense on the income statement, this is a finance lease where as if the lessee is the owner, and that's why like the owner, the lessee is going to have an interest expense and a depreciation / amortization expense on its income statement. And we've seen how this interest expense comes into being. Let's get back again to our example. So we've seen over 5 years how this lease liability number 12711 gets amortized from a 122,711 to $45,000 at the end of 5 years, and then to zero when the lessee pays the 45 and buys the asset. The interest expense, this is going on the lessee's income statement. Lease liability is getting reduced by every interest expense, and the lease liability, of course, lease liability is getting increased, bloating up with the interest expense, and the lease liability is being paid in cash each period. Now, let's talk about the right of use asset. Now, when you look at this right of use asset, which is on the lessee's asset side, let's get back again. So we've amortized this lease liability from a 122,711 to 0. So this was 122,711 and over 5 years we took it off. Similarly, the right of use asset is also 122,711 and this needs to be amortized. Now, the period that we would use, so if the lessee had met the N or the E or the R criteria, we would have amortized this asset over the lease life, which is 5 years. But because the lessee in this example meets the W criteria, so whenever the lessee meets the O or the W criteria, we use the asset life to amortize this. And the asset life here is 10 years. So the right of use asset, this number 122,711 will be amortized over 10 years. So 122,711 divided by 10, it would be about 12,271. So that would be the amortization expense each period over 10 years. Because guys, the lease is going to get over after 5 years. But after 5 years, we are anticipating that the lessee will buy the asset at the bargain purchase price. So the lessee will have the asset forever for all the 10 years that the asset would survive. So we would amortize this and get this to 0 over a 10-year period. And let's do our journal entries for that. So we have number 1, number 2, getting to number 3. Number 3, our agenda is looking at the right of use asset. And the journal entry would be amortization expense to accumulated amortization, which is a contra asset. So accumulated amortization, which is a contra asset to the right of use asset. So let's look at this. So the amortization each period over 10 years. So let me say X1 to X10 would be 12,271 each period. So every year the right of use asset will come down such that at the end of 10 years it will become 0 because the asset life is anticipated to be 10 years. So here we are talking about how do we amortize the right of use asset. So we started with the asset and a corresponding liability. In 5 years, the liability was gone. 10 years, the asset is gone. On page 37, we're looking at accounting for finance leases by the lessee. And at the commencement date, we're going to have journal entry number 1. Where there is a highlight right of use asset recognized by the lessee on its balance sheet and a corresponding highlight lease liability. So this lease liability is basically the present value of lease payments not yet paid. It includes the present value of periodic lease payments plus any required buyout by the lessee. So that is the O of owner. So owner and circle O. It also includes present value of any optional buyout which the lessee is expected to exercise. So once again, owner and this one's circle W, the written purchase option. And the lease liability also includes the present value of any residual value guarantees by the lessee if the lessee is expected to be paying something to the lessor. after the commencement date, the lease liability is amortized over the lease term. And that one is right, journal entry number 2. Highlight, amortize the lease liability over the lease term, such that there is highlight an interest expense recognized each period on right I/S on the income statement, and put a box around this. So once again, the lease liability is right, amortized over lease life, where we underline use an amortization schedule. So on this amortization schedule, the lease liability is increased to reflect the periodic interest on the lease liability, which is interest expense debit and lease liability credit. Also, the lease liability is reduced to reflect the lease payments made during the period. So that's lease liability debit to cash credit. So that's about the lease liability amortization. In right, journal entry number 3, we also need to highlight amortize the right to use asset, where there is highlight an amortization expense recognized on the lessee's right I/S or the income statement, and put a box around this, because once again, the right to use asset is right, amortized over lease life or asset life by the lessee. So once again, we're talking about finance lease, where the lease terms are as if the lessee is the owner of the asset. And that's where you have a right of use asset debit and a lease liability credit on journal entry number 1. On the second journal entry, we're talking about amortizing the lease liability. And here on the third journal entry, we amortize the right to use asset. Now use underline straight line basis unless another systematic and rational basis better represents the pattern in which the lessee expects to consume the right of use assets future economic benefits. The period for amortization, if highlight O or W criteria is met, amortize over the asset underline useful life. But if the lessee meets the highlight N or highlight E or highlight R criteria, then amortize over underline lesser of useful life or lease term. To summarize, let's make notes towards the bottom of the page. Right? Lessee expense on income statement. If it's right, an operating lease, the lessee recognizes a lease expense or a rent expense on its income statement. But if it is a finance lease, as we see here, the lessee is going to have right interest plus amortization expense on its income statement. let's look at the example on page 38. We have the lessee company leasing from lessor company equipment for 5 years at $25,000 underline payable at the end of each year. So this one's like an ordinary annuity. The asset life or the life of the equipment is 10 years and the lessor's carrying value is $120,000. At the end of the lease, estimated residual value of the asset is $60,000. However, the lessee has an option of purchasing the asset for $45,000 that the lessee is reasonably certain to exercise. So this one sounds like a bargain purchase option. Right there, owner and circle W. And that is why this one's a finance lease. And now we're going to have journal entry number 1, where we put a box around capitalize the right of use asset and the lease liability. And look at the journal entry there. We have right of use asset at $122,711 and a corresponding lease liability for the same amount. As we move to write journal entry number 2, we're talking about put a box around amortizing the lease liability. So on journal entry number 1, where we recognized the lease liability of $122,711, let's write amortize over lease life of 5 years. And draw an arrow from there to the amortization schedule. On the amortization schedule for the lease liability, we start with the lease liability value of highlight $122,711. Over the 5-year period, we're looking at highlight interest at 10% of the balance lease liability carrying value. So cumulatively over 5 years, the total of interest and draw bracket is $47,289. And the lessee is also making lease payments of $25,000 at the end of each year over 5 years. At the end of 5 years, the lease liability carrying value is now highlight $45,000, wherein now the lessee pays the bargain purchase price of $45,000 to get the lease liability to highlight 0. The lease payments by the lessee is $25,000 into 5 years. So that's $125,000 plus another $45,000 to purchase the asset at the end of the lease term. So in total, we expecting the lessee to pay $170,000. And then we have, right, journal entry number 3, where we're talking about, put a box around, amortizing the asset. So get back to journal entry number 1, where we had capitalized the right of use asset and recorded a corresponding lease liability. So the right of use asset there was 122,711. Right there, this is amortized over asset life of 10 years. Because in this case, the lessee meets the W criteria, which means that the lessee is going to use the asset for its entire 10-year life. And that is where the right of use asset is amortized over 10 years. So coming down back to journal entry number 3, we're going to have amortization each period of $12,271. This is going to happen right into 10 years, where we will amortize the entire right of use asset of right 122,711. Towards the bottom of this page, let's draw out a dollar number line with a couple of milestones. The first milestone is right present value of the lease asset, which is right 122,711. And the second milestone is the entire amount of right lease payments, which is $170,000 over 5 years. Now, from an income statement perspective, the lessee is going to record right asset amortization expense of 122,711 over right 10 years. So the entire value of right of use asset 122,711 is amortized over 10 years, leading to an amortization expense on the lessee's income statement. And we see that in journal entry number 3. On top of this asset amortization expense in journal entry number 3, we also have right interest expense in journal entry number 2. And we've seen that the interest expense over the 5-year lease term is right $47,289. And this one's recognized over right 5 years. So guys, once again, the lessee is making payments of $170,000 to the lessor. The entire $170,000 basically is getting expensed on the lessee's income statement. But unlike an operating lease, this one's not expensed as a lease or a rental expense. Because the lessee is like or as if the owner of the lease asset, the lessee is having an asset amortization expense to the tune of the present value of the right of use asset, and the extra amount, the difference between the present value and the actual $170,000 is
interest expense recognized by the lessee.
We'll now look at another example on finance lease where you know that the lessee is the owner. We're going to use the same template, the three journal entries that we have from the lessee perspective. What I've done is, from the previous example, I've just erased the dollar numbers so that we have our screen, our dashboard already. So let's look at this. So it says on 1st Jan, the lessee leases from lessor equipment for 5 years with $25,000 payable at the end of each year. Again, similar numbers to what we saw on the previous example. The asset life once again is 10 years. But what's different here is that we have the fair value of the asset mentioned, which is 132,025. The lessor's carrying value still is 120. Now it says at the end of the lease, estimated residual value of the asset is $60,000. However, the lessee provides a residual value guarantee of $50,000. Okay, so now this one is a little different, right? So the previous example that we saw, the lessee met the W criteria, where the lessee had a bargain purchase option at the end of the lease. That's not there here. What we have, however, is we feel that there's a lot of money that the lessee is committing to this lease. So let's check for the E of the owner criteria. So you have present value of the lease payments. So $25,000 each year, 5 years. That's an ordinary annuity. 5 years, 10%. The present value is 3.79079. Multiply it by $25,000. We'll get 94,770. Plus, we have a $50,000 residual value guarantee provided by the lessee. So that $50,000 5 years from now, present value factor is 0.62092. So overall, looking at the lease payments by the lessee plus the residual value guarantee, the overall present value of lease payments including that guaranteed residual is 125,816. Fair value given is 132,025. Now what we have is the present value is actually 95% of the fair value. Now of course that's greater than 90%, therefore this lease meets the requirement of finance leases. This lease ensures that the lessee is the real owner. The lessee meets the E of the owner criteria. Now let's look at journal entries. So we're going to start with the lessee, who's now the owner, meets the E criteria, recognizing a lease asset and a lease liability. Now for the E criteria, we had considered the present value of the annuity, $25,000 each year, plus the present value of the residual value guarantee that the lessee provided. But the question mentions that at the end of the lease, the estimated residual value is $60,000. So there's a high chance that the lessee, though the lessee is providing that guarantee of 50, the value of the asset would actually be 60. So the lessee won't have to pay anything. So from a lessee perspective, it is probable that the lessee will not owe anything under the residual value guarantee. Therefore, on the commencement of the lease, the lessee would capitalize the right of use asset of only 25,000 into 3.79079, that's 94,770. So we'll have the lessee having a lease asset 94,770 and a lease liability 94,770. Now, as you know, journal entry number 2, we're going to be amortizing this lease liability. Journal entry number 3, we're going to be amortizing the lease asset, the right of use asset. So let's do the lease liability first. So 94,770, let me bring it on to our amortization schedule. 10% is the interest rate. So 10% of 94,770 is 9477, and then there is a lease payment of $25,000. So we know that's lease payment is going to be $25,000 each period. So let me put that right here. Over 5 years, $125,000, right? And then so 94,770, 9477 minus $25,000. The plug in year 1 would be 15,523. So you have 15,523 as a plug. It's of course a negative plug. So 94,770 comes down to 79,247. Now 79,247, again 10% of that, 7,925. That's correct. Yeah, 7,925 minus the $25,000. We have the plug, a negative plug of 17,075. 79,247 comes down to 62,172. Again, 10% interest on 62,172. The balance lease liability carrying value at the end of year 2. So that's going to be 6217. Less the $25,000 paid by the lessee to the lessor at the end of each year. The negative plug will be 18,783. So 62,172 minus the 18,783, we get 43,389. 43,389. Let's take 10% of this. So that's going to be 4,339. That's correct. Yeah, 4,339. That's the interest for year 4 minus the $25,000 lease payments. The negative plug is 2661. The balance carrying value for the lease liability at the end of year 4 is 22,728. Again, 10% interest, 2272 minus $25,000 lease payment, negative plug of 22,728 at the end of 5 years. The 94,770 is a 0. It's gone. So that's how we have amortized the lease liability. Of course, at the end of 5 years, the lessee has a residual value guarantee of $50,000. But we don't take that into consideration here because the estimated residual value of the asset is 60. So we presume that the lessee won't have to pay anything, and the lessee just pays the $25,000 each year over 5 years. Let's look at the asset. Or rather, even before we go there, let's complete these journal entries. So this is going to be easy, right? So interest expense each period. First year 9477, second year 7925, 6217, 4339, 2272. Of course, you're going to have the same number on the credit side where you're sort of bloating up the lease liability, right? So the interest amount is increasing the lease liability, and then you have the lease payment which is reducing. So the lease liability is credit, that means it's bloating up. So 9477, same number, 7292, 6217, 4339 and 2272. And the lease liability each period over 5 years gets reduced by $25,000 as the same amount is paid by cash. So 25, so let me do it religiously. 25,000, 25,000 year 3, 25,000 in year 4, and then again at 25,000 in year 5. Right, so that was simple, just like fill in the blanks. Okay, now so we're done with the lease liability plus the interest minus the lease payments. So it sort of keeps reducing, gets to a 0 at the end of 5 years. Now let's talk about the lease asset, the right of use asset, which is at 94,770 at lease commencement. Now, in the previous example, when the lessee met the W criteria, we amortized the asset over the asset life of 10 years. Because we knew at the end of 5 years, the lessee had a bargain purchase option. The lessee would buy the asset and of course use the asset for all its life. But now in this example, we are looking at the E criteria being met. And the lessee would have access to the asset only for the 5-year lease term. So the amortization of this right of use asset will be over 5 years. So if we do a 94,770 by 5, each year you would have an amortization of 18. So each year 18,954. And this is going to be year 1 to year 5. So guys, just a quick recap, right? So beginning of the lease, let's get back to our dashboard. Beginning of the lease, you have the lessee having the lease asset and the lease liability. Over the period of the lease, the next 5 years, the lease liability that's amortized, resulting in an interest expense on the lessee's income statement. Also, the right of use asset, that's also amortized. That's what we saw in our journal entry number 3. And as the right of use asset is amortized, it results in creation of this amortization expense on the lessee's income statement. So once again guys, this is a finance lease. The lessee no longer has lease expenses on its income statement. It's as if the lessee is the owner, and that's where you have interest expense, amortization expense on the lessee's income statement.
On page 39, we are again looking at a finance lease from the lessee's perspective. So once again, we're wearing the lessee's hat. And we know the lessee leased from lessor equipment for 5 years at $25,000 payable at the end of each year. The asset life is 10 years. The fair value of the asset is $132,025, while the lessor's carrying value is only $120,000. At the end of the lease, the estimated residual value of the asset is $60,000. However, the lessee provides a residual value guarantee of $50,000. So let's look at the solution, starting with journal entry number 1, where we're going to put a box around capitalize asset, the right of use asset, and liability, the lease liability. Now, in this example, highlight the present value of lease payments, including the guaranteed residual, is $125,816. And this present value, highlight, is 95% of the fair value of $132,025. And therefore, it satisfies the E of the owner criteria. So right there, owner and circle E. Highlight, however, since the guaranteed residual, which is $50,000, is less than the estimated residual value of $60,000, it is probable that the lessee will not owe anything to the lessor under the residual value guarantee. Therefore, when we capitalize the right of use asset for the lessee and also recognize a corresponding lease liability, we're just going to use the $25,000 payments that the lessee would make to the lessor over 5 years, and we present value that. This calculates to $94,770. And in journal entry number 2, we are put a box around amortizing the lease liability. So starting with the lease liability carrying value of highlight $94,770. Look at interest at 10% each period over 5 years. Drop bracket. The total interest expense, right, is $30,230. Over the 5 years, the lessee is expected to pay $25,000 each year. Total lease payments of right $125,000. So on the amortization schedule for the entire 5-year period, we start with the lease liability carrying value of $94,770 plus the interest expense over 5 years of $30,230 minus the lease payments of $125,000 again over 5 years. At the end of year 5, the lease liability carrying value is highlight $0. So we have successfully amortized the lease liability using this amortization schedule. And let's also look at right journal entry number 3, where the lessee put a box around amortizes the right of use asset. Now in this example, since the E criteria is met and the lessor will take back the asset after 5 years, the asset amortization happens over 5 years over the lease life. So the amortization each period is $18,954, right, into 5 years gives you right $94,770. So once again, on journal entry number 1, we recognize the right of use asset and the lease liability. Journal entry number 2, amortize the lease liability of $94,770. Journal entry number 3, amortize the right of use asset of $94,770. And to recap this, let's draw out a dollar number line towards the bottom of the page and have a couple of milestones there. The first milestone, right, present value of asset, which is right $94,770. And the second milestone is right lease payments of $125,000. So once again, guys, this is not an operating lease where the lessee would recognize a lease expense on its income statement. This one's a finance lease. So the lessee would recognize right asset amortization expense to the tune of right $94,770 over 5 years. And the remaining is right interest expense of $30,230 again over 5 years. So guys, the lessee is paying a total of $125,000 to the lessor. Had this been an operating lease, that $125,000 would have been expensed as a lease expense on the lessee's income statement. But this one's a finance lease where the lessee is as if an owner of the asset and the lessee recognizes amortization expense of $94,770 and interest expense of $30,230.
Guys, now that we have done a deep dive into finance leases, let's take a step back and talk about operating leases. So, from a lessee standpoint, an operating lease is a lease where the lessee is not the owner. Or in other words, the lessee does not meet any of these owner criteria. And before we start getting into details for operating leases, let's once again reinstate our basics for leases. And if you remember, I started leases like a story of the lessor and the lessee, where the lessor owned certain assets, certain property, certain PP&E. Let's put that on the lessor's balance sheet once again. So the lessor owns certain PP&E, which the lessor allows the lessee to use, allows the lessee to control for a period of time in exchange for consideration or rent. So basically, the lessee pays rent to the lessor. So on the lessee's income statement, there's a lease expense. For the lessor, this is lease or rental income. And then of course, we saw the lessor owns the PP&E. The lessor also has a depreciation of this PP&E. The lessor may have taken a mortgage loan and may be paying interest expense on that. But when we spoke about operating leases, rather we spent some time on short-term leases, leases of 1 year or less. And we had the exact same structure there. The asset, the PP&E, was on the lessor's books. The lessee incurred lease expense, the lessor lease income. But when we started getting into finance leases, it was magic. The PP&E magically disappeared off the lessor's books and went into the lessee's books, where the lessee had a right of use asset, a lease liability. We saw that the lessee did not recognize the lease expense on its income statement any longer. Instead, the lessee, who in a finance lease was the owner in substance, started having amortization or depreciation expense and interest expense. As if, again, the lessee was the owner. But now we're talking about operating leases, where the lessee, once again, is not the owner. The lessee does not meet any of these criteria. And for operating leases, the accounting, or rather the reporting, used to happen exactly like this. So let's say we talk about an airline who leases all its aircraft, and most airlines do. So we have lessors who own the aircraft, and the lessee, the airline company, is leasing all its aircrafts. And let's say the airline company is leasing all its aircrafts for, let's say, 3 years or 4 years on operating leases. None of them are finance leases. In that case, if we look at this reporting structure, the airline company would actually have no aircraft on its balance sheet. And that sounds strange. You're talking about this airline company which is leasing airlines from lessors, owners of the airline, or the owners of the aircraft, but having no aircraft on their own books. And the standard setters said, hey, this is not okay. So now, as per the new rules for lease accounting, which are applicable after December 15, 2018, so as per these new rules, even for operating leases, the lessee needs to recognize a lease asset and a lease liability. So guys, understand, for finance leases, the lessee met one of the owner criteria. And we said this goes off here into the lessee's books. But now we're talking about operating leases, where the lessee is not meeting any of these criteria, yet the lessee would be recognizing a right of use lease asset here and a lease liability. But unlike a finance lease, this PP&E in an operating lease does not go off the lessor's books. So the PP&E remains on the lessor's books in an operating lease, but the lessee recognizes a asset and a liability. Not much changes from an income statement perspective. So in a finance lease, we saw that the lessee had amortization expense and interest expense here. But in an operating lease, the lessee will continue to have a lease expense. So guys, what's really changed is the way the lessee's balance sheet now looks. So let's say, again, the lessee is an airline company leasing aircraft for, let's say, a 3-year lease period, all operating leases. Now the lessee will start showing those leases on its balance sheet. And that's the change that's happened for operating leases. So guys, we sort of deep dived into finance leases, so I'm not talking about that. But talking about operating leases, where we are just getting into, if it's a short-term operating lease, which is 1 year or less, then this is not required. But for other than short-term operating leases, the lessee, even for that operating lease, will have a lease asset and a lease liability on its balance sheet. And to understand this better, let's look at an example on our book. So you have this example where on 1st Jan year 1, lessee leases from lessor. Again guys, a story of the lessee and the lessor. Equipment for 3 years, where the lessee would pay the lessor $20,000 at the end of year 1, $25,000 at the end of year 2, and $30,000 at the end of year 3. The asset life is 10 years. The rate implicit in the lease is 10%. The lease is an operating lease. Very simple. The lessee does not meet any of the owner criteria. So let's talk about how do we, in this operating lease, which is of course more than 1 year, how do we recognize the lease asset and lease liability on the lessee's balance sheet? We'll also look at the lessee's income statement, the lease expense that we have on the lessee's income statement. If you realize, the lease payments here are uneven, 20, 25 and 30. Now the standards require that the lease expense be recognized on a straight line basis. So if you look at 20 plus 25 plus 30, so that's 75 divided by 3 years, 25 per year. So as per the standards, the lessee would have to recognize a lease expense of $25,000 per year for 3 years. Even for the lessor, we'll talk about the lease income being recognized at $25,000 per year over 3 years. For the lessor, once again guys, this is an operating lease. So the PP&E stays on the lessor's books. Let's get on the other side of my board and we're going to rock this. Okay, so we've looked at finance leases. This one is operating. In an operating lease, from a lessee perspective, very clear, lessee is not the owner. Basically, the lessee does not meet any of these owner criteria. And then, even though it's an operating lease, we've been clear, we still have to have a lease asset and a lease liability on the lessee's balance sheet. Guys, note, This one's an operating lease which is not 1 year or less. It's not a short-term lease. It's more than 1 year, 3 years. So we need to have this lease asset or a right of use asset on the lessee's balance sheet and a lease liability. Now we're going to be looking at the cash flows and do a present value of those lease payment cash flows. So the lessee is paying the lessor $20,000 at the end of year 1. So present value of $1 at 10% interest if n is equal to 1 year is 0.90909. So it's $20,000 into 0.90909. For 2 years, it's the present value number factor is 0.82645. So it's $25,000. The amount the lessee is paying at the end of year 2 into 0.82645. The present value factor if n is 3 years is 0.75131. So the $30,000 that the lessee is paying the lessor at the end of year 3, that's multiplied by 0.75131. So after doing all of this maths, we get that the present value of lease payments is 61,382. So let me put that number here. Of course, guys, you realize this lease asset and this lease liability will remain on the lessee's balance sheet only for the lease term. So our agenda would be again simple: amortize the asset and the liability. We got to sort of get them to zero by the end of the lease term. So let us look at the amortization schedule, slightly different from the one that we saw in case of finance leases, but let's just knock it off the way it is right here. So we're looking at 3 periods here, and for those 3 periods we're looking at actual payment and the expense. So let me put that here. So we're looking at period, we're looking at the actual lease payment, and then we're looking at how much is the lease expense on the lessee's income statement. Interest, the implicit rate is 10%, so let's take that, and then we are looking at a plug here, and I'll talk about how the plug works. Let's get both the numbers here. Let's get the lease asset or the right of use asset and the lease liability here. So let's get the beginning numbers down here. So the right of use asset, this one is 61,382. The lease liability is again 61,382, and both these need to get to a zero in 3 years. So let us look at the first year, X1. So 1231X1. So, or rather, let me put all the 3 years together, X2 and 1231X3. Now, the lease payment that the lessee is making to the lessor is 20,000 here, 25,000 here, and 30,000 here. Let's do the journal entries for these lease payments. So whatever lease payments are happening, we'll show it as a reduction of the lease liability. So the journal entry would be lease, lease liability debit and cash credit. So we're looking at X1, X2 and X3. Year 1, 2, 3. So year 1, 20,000 is paid. Year 2, 25,000 is paid. And year 3, $30,000 is paid by the lessee to the lessor. So this is all good. But what I also told you is when we're looking at these lease payments which are uneven, when we get to lease expense, we're going to straight line this. So the lease expense on the lessee's income statement would be on a straight line basis. So for 3 years, this is $75,000, but the lease expense that would be recognized would be $25,000 each year. Same dollar for each of the 3 years. Straight line basis. So when we do the journal entry for the lease expense, so here is the payment journal entry. But when we do the journal entry for the lease expense, the amount is going to be $25,000 each year for 3 years. Now, let us look at the interest component here. So we're going to have an interest on the lease liability. So that's how we amortize it. So let's look at this. So if you're looking at the lease liability of 61,382, 10% of that is 6138. So when we look at the lease liability, so the lease liability in year 1 will be reduced by the amount of lease payment minus $20,000 plus 6138. So remember the amortization schedule, so where we had 61,382 plus 6138 minus $20,000. So the lease liability at the end of year 1 would be 47,520. Now on this 47,520, we're going to again have a 10% interest. So the plus number 4752. So 47,520 plus 4752 minus the 25,000 lease payment. So that's going to be 27,272. Sounds good. 27,272, and then you have the third year interest of 2,728. Perfect. So 27,272 plus 2,728 minus $30,000. That's the payment. The lease liability at the end of year 3 would be 0. So guys, looking at the lease liability. So what you're doing here is the lease liability, of course, was reduced by the amount of lease payments, but the lease liability is increased. It's credited by the amount of interest. So if you look at the lease liability here, the numbers here are going to be 6138, 4752 and 2728. So guys, if we look at the 3-year period, the lease liability of 61,382, to that we add the interest amount for the 3 years and we subtract the payment of 75. So 61,382 plus these 3 numbers would get to $75,000, and that's the amount of lease payment, $75,000. The liability at the end of year 3 becomes 0. Now, what do we do in an operating lease scenario? If you look at the first journal entry, the debit is equal to the credit, all sorted. But if you look at the second journal entry, of course the debit is not equal to the credit. To balance these journal entries, we will put in a plug, and that plug would be to the lease asset. So the lease asset would be the plug number so that the debit equals credit. That's the basic of accounting. So in year 1, the plug is 18,862. In year 2, the plug is 20,248. Year 3, the plug is 22,272. And these plug numbers that you have, let's take them up here. So if you look at the right of use asset, starts with 61,382. At the end of year 1, it's credited, it's reduced by 18,862. So if I do minus 18,862, this becomes 42,520. At the end of year 2, further reduction, further credit. Again guys, the asset is credited, gets reduced by 20 to 48. This number at the end of year 2 becomes 22 to 72. And then at the end of year 3, 22 to 72, and that's gone. And the right of use asset is also amortized. So guys, the trick here was this plug number that we had for the right of use asset. So the lease liability was being paid in cash, and of course we were adding on the interest to the lease liability, but for the lease expense amount, the plug was the right of use asset, which helped us amortize this asset to get this to a zero. So let's quickly get to the dashboard and look at what happened here. So day 1, lease commencement, we started off with the right of use asset of 61,382 and a lease liability of 61,382. Over the 3-year period, this became 0, this became 0. And lease expense was recognized on the lessee's income statement such that year 1 or X1, the lease expense was 25,000. Year 2, the lease expense was 25,000. X3, the lease expense was 25,000. So guys, old rules, we just had this. Old rules, we never had the asset and the liability in case of an operating lease. But new rules require that the lessee recognizes a lease asset and a liability even if it's an operating lease, especially if that operating lease is more than 1 year. So let's look at the simplified version of this journal entry. Think about it. Let's say, had we not had the lease asset and the lease liability, and this was supposed to be very, very simple, then ideally what you would have had is you would have lease expense on your debit side and cash on your credit side. That would have been the simplest, and that's the net effect that's happening here. If you look at over the 3 years, lease expenses 25 plus 25 plus 25. Total lease expense over 3 years is $75,000. And the cash paid out over 3 years, 20 plus 25 plus 30, that's again $75,000. So had we not had a lease asset and a lease liability to amortize, had we kept it very, very simple, again, old rules which were simple for operating leases, just had the lease expense to cash. But of course, new rules, you recognize the asset and the liability, and now it's a mandate for you to get the liability off, get the asset off over the lease term. And that's why it just becomes a little complicated, but I'm sure with this structure, with the logic that we have, it shouldn't be too bad.
Now, we are looking at operating leases, starting page 30. From the perspective of a lessee, an operating lease is any lease other than a finance lease, where lessee is not equal to owner. From the lessor perspective, an operating lease is any lease other than a sales type lease or a direct financing lease. So let's look at the update box out here. It says FASB issued Accounting Standards Codification 842 to amend accounting and reporting for leases effective fiscal years beginning after December 15th, 2018 for issuers and December 15th, 2019 for non-issuers. Highlight the most significant change in ASC 842 is the lessee model that brings most leases to the lessee's balance sheet, thereby avoiding any off-balance sheet arrangements. On page 31, we're looking at accounting by lessee for an operating lease. At commencement date, the lessee would put a box around capitalize, highlight right of use asset, and recognize a corresponding highlight lease liability. And right there, no longer off balance sheet financing. So whether it's a finance lease or an operating lease, the lease liability for the lessee is now on the balance sheet. Now, after commencement date, the lessee would put a box around record lease payment. So lease payment is treated as payoff for lease liability, where the lease liability comes down. So draw a downward arrow there. And of course, the credit is to highlight cash. The lessee would also put a box around expense a single lease cost on a straight line basis over the lease term. So the lessee would have highlight lease expense and write on income statement. The credit to the lease expense would be, the first one is lease liability, right there, interest added, which results in the lease liability going up. So draw an upward arrow there. And the next credit is to the lease right of use asset, which is circle the plug number. Basically, this is how the right of use asset is amortized. So right there, amortize. On page 33, we've got an example on operating lease. And we know this lease was for, put a box around 3 years, where underline $20,000 was payable at the end of year 1, underline $25,000 at the end of year 2, and underline $30,000 at the end of year 3. Now the lessee recognizes a right of use asset and a lease liability at the lease commencement date, and these are amortized over the lease period. Look at the table there. Highlight lease asset carrying value, which is highlight $61,382 as of the lease commencement date, and is amortized to highlight $0 at the end of year 3. Similarly, highlight lease liability carrying value, which is highlight 61,382 on the commencement date, and is amortized to highlight $0 by the end of the lease term. Now, during the lease term, the lessee recognizes highlight lease expense on the income statement and draw a box around the numbers. So the lessee expenses on income statement on a straight line basis. There's a $25,000 expense each period over the next 3 periods or next 3 years. Let's look at the journal entries. The first one, actual lease payment. That's like, payoff for lease liability, which comes down. So draw a downward arrow and put a box around the numbers. So year 1, $20,000. Year 2, $25,000. Year 3, $30,000. All of this is highlight paid in cash. Again, highlight the numbers $20,000, $25,000 and $30,000 for the 3 years. The next journal entry is for recognizing, highlight lease expense, which is recognized right on income statement. And as we've seen, lease expense, that's going to be recognized on a straight line basis. So that is highlight $25,000 for each of the 3 years. The first credit is to lease liability. Basically, right, interest added, which increases the lease liability. So draw an upward arrow and put a box around the numbers. 6138 for year 1, 4752 year 2, and 2728 for year 3. The second credit, which is circle plug, is to right of use asset. So right there, amortize. So the right of use asset is credited, basically amortized, such that at the end of the lease term, the lease asset or the lease right of use asset carrying value is $0. Turn on to page 40, where we'll recap the financial reporting for lease accounting. On this page, we've got put a box around lessee financial statements. And let's do this page bottom up. So on the third sub-bullet, underline finance lease. So in case of finance lease, where the lessee meets one of the 5 owner criteria, the lessee would recognize, highlight a right of use asset on its balance sheet and a corresponding highlight lease liability. On the lessee income statement, we'll have highlight amortization of the right of use asset and highlight interest expense on the lease liability. Make a note there, right? Total expense in case of finance lease for the lessee is front loaded, which means, right, it's higher in the initial years. Now, moving up on this page, underline operating lease. Now, we've seen under the new standards, even for operating lease, the lessee needs to recognize, highlight a right of use asset and highlight a corresponding lease liability on its balance sheet. However, on the lessee income statement for operating leases, we still have highlight lease expense, which are recognized underlined on a straight line basis. Now for operating leases, there's an exception option which is available for underline short-term lease. As per that exception option, the lessee does not need to recognize any right of use asset or a lease liability on its balance sheet. And the lessee would continue to have highlight a lease expense on its income statement, which is recognized once again on underline straight line basis. We're looking at put a box around lessor financial statements. Right.
Cover in BAR, Business Analysis and Reporting section of the CPA exam.
Let's start with underline operating lease, where if we look at the lessor balance sheet, highlight PP&E is still right on lessor's books. On its income statement, the lessor would have highlight lease income, which is recognized on a straight line basis, and he may have highlight depreciation expense as the lessor depreciates the PP&E. Now, if the lease classification for the lessor is underlined sales type lease, which is when the lessee meets one of the owner criteria, in that case, the PP&E goes right off lessor's books. And the lessor instead recognizes highlight NIL or the net investment in lease. On its income statement, the lessor would recognize highlight interest income and any highlight selling profit. The interest income is recognized over the lease term. The selling profit is recognized in year one on the lease commencement date. Now for underlying direct financing lease, even here the PP&E goes right off lessor's books. And the lessor recognizes highlight NIL or the net investment in lease. The lessor's income statement reflects highlight interest income recognized over the lease term. And even if the lessor has any selling profit, that's deferred and included along with the interest income over the lease term. On page 27, we're looking at lease classification, where the standard setters have ensured that there's right substance over form. Now for put a box around lessee, the lease may be classified as highlight finance lease or highlight operating lease. Now the next sub-bullet, we're talking about lease classification for put a box around lessor. So for lessor, we have seen a lease could be highlight a sales type lease or highlight a direct financing lease or an highlight operating lease. Before we move on, let's look at page 28, where we're talking about what all is included in put a box around lease payments. So the first one there, lease payments include highlight fixed lease payments, which is right periodic lease payments plus any required buyout by lessee. So required buyout, that's typically the O of the owner criteria. Now, fixed lease payments underline include in substance fixed payments, which means payments that appear variable but are in effect unavoidable. Now, from these fixed lease payments, need to underline deduct any lease incentives. Now, lease incentives include any payments made by the lessor to the lessee. So, reverse direction. Instead of the lessee paying the lessor pays the lessee, and that's why we call it lease incentive. Now, the fixed lease payments, they highlight include variable lease payments that depend on an index or rate. For example, the consumer price index or a market interest rate, which are highlight initially measured using the index or rate at the commencement date. And let's look at the example that we have here. Lease requires $10,000 lease payment per year for 3 years that will increase each year based on CPI. The lease liability is calculated based on $10,000 cash lease payment for each of the 3 years, irrespective of the expectation of changes in CPI. Thereafter, say in year 2, if CPI increases by 4%, actual lease payment will be $10,400, of which highlight $10,000 will be treated as the fixed lease payment, which is also used to calculate the lease liability, and highlight $400 will be the variable lease payment, which wasn't used to calculate lease liability. To build upon this, let's look at the last sub-bullet on this page, which talks about lease payments do not include, right there, not, and highlight variable lease payments other than what has already been included. So lease payments would not include variable lease payments, highlight that are based on the usage or performance of the underlying asset. For example, percentage of revenues. So moving up again, the lease payments would include variable lease payments that depend on an index or rate, but we only take the initial measurement using that index or rate at the commencement date. Fixed lease payments, as we said, do not include any variable lease payments which are based on usage or performance of the underlying asset. Now, lease payments also include highlight optional payments, right there, plus optional buyout expected to be exercised by lessee. So this is like the W of owner, where the lessee is expected to exercise the purchase option, which is often a bargain purchase option. So payments to be made in optional periods are included, highlight only if the lessee is reasonably certain to exercise the option. Underline to extend or not terminate the lease. Optional payments, underline to purchase the underlying asset, is included only if the lessee is reasonably certain to exercise that purchase option. Once again, that's the W of owner. Now, lease payments also include any residual value guarantees. So right there, plus residual value guarantees. For lessee, we look at the amount that is probable to be owed under the residual value guarantee. For lessor, we're looking at the amount at which the residual assets are guaranteed by the lessee or even a third party. And we saw that for direct financing leases. On page 29, let's look at, put a box around discount rate to be used for the lease accounting. Highlight for lessor, use highlight rate implicit in the lease. For lessee, once again, use highlight rate implicit in the lease if readily determinable. In other words, right, use lessor's rate even for lessee. Now, if that is not readily determinable, then need to use underline, otherwise use lessee's incremental borrowing rate. Underline for lessees which are non-public entities, may make an accounting policy election to use the risk-free discount rate for all leases.
Let's now talk about initial direct lease costs, which are incremental costs of a lease which would not have been incurred if the lease had not happened. And a very good example here is broker commissions. Neither the lessee nor the lessor would pay the brokers any commission if the lease hadn't happened. Now, for these initial direct lease costs, lessees typically defer them. Basically, they include the initial direct lease costs along with the right of use asset, and those costs are expensed over the lease term. So if it's a 3-year lease, expense it over 3 years. If it's a 5-year lease, expense over 5 years. Same thing. Typically, lessors also expense their any initial direct lease costs over the lease term. But for lessors, there are certain exception cases where the lessors are required to expense the initial direct lease costs at lease commencement, immediately upfront.
On page 48, we are looking at put a box around initial direct costs for a lessee. Now, these are costs to negotiate or arrange a lease. These are highlight incremental costs of a lease that would not have been incurred if the lease had not been obtained. It may include underlying commissions, may include underlying payments made to an existing tenant to incentivize the tenant to terminate its lease. Now, these initial direct lease costs highlight do not include costs that would have been incurred regardless of whether the lease was obtained. So these initial direct lease costs do not include any fixed employee salaries, do not include general overheads, do not include costs for advertising, for solicitation, or costs related to activities that occur before the lease is obtained. Now on the table here, put a box around lessee. Now, whether it's an operating lease or a finance lease, highlight you got to defer the initial direct costs by including in the right of use asset. Basically, expense this over the lease term. Let's look at an example that we have here. It says lessee and lessor enter into an operating lease. The following costs are incurred in connection by the lessee. You have external and legal fees. You have allocation of employee costs for time negotiating lease terms and conditions. Highlight payments made to existing tenant to obtain the lease. Highlight $12,000. That's the lessee's IDC or the initial direct cost. And then you have the total cost which is incurred by the lessee, which is $25,000. Calculate the amount treated as initial direct cost for lessee. So you got solution, highlight lessee's initial direct costs. It says lessee, highlight includes 12,000 of the initial direct costs in the initial measurement of the right of use asset. Lessee amortizes these costs ratably over the lease term as part of its total lease cost.